Okay? The fund of funds business sort of blows. Okay? I can give you hundreds and hundreds of reasons why it blows. The first one is the fees on top of fees. Okay, that's the first one. Okay, yet I could also submit to you that the coffee business wasn't such a great business. Now, maybe many of you are not aware of this, but they did serve coffee in the United States before Starbucks. Now, maybe people in this room are not aware of that, but they did do it. And it was probably 75 cents a cup. You get it at your local diner or you get it at McDonald's. But today, crushed coffee beans with hot water, you're buying it for $2.50, and if you're getting a latte, it's $4 or $5. Okay, there were MP3 players in the United States before the iPod. Okay, they just weren't as successful because what happened was there were some design flaws, and there was somebody that needed to look at the music industry and say, hey, people will pay $1 for a song. Let me just get a good website up there. I'll get a little sexy piece of machinery, which is identical to everybody else's MP3 player. It's as functional, and we are going to revolutionize music. Okay, now, Apple Computer, I'm a little off base here, but I really want to make the point to people that have hedge funds that are thinking about differentiating themselves. Apple Computer, in 2003, Michael Dell was asked a question at a podium like this: what should Steve Jobs and the management team at Apple do? What should they do? Now, he said, and I know he regrets this, but he said they should return the money back to the shareholders. That's what they should do because they're out of sorts, they have no market share, et cetera, et cetera. Now, I want you to think about this. The iPhone came out in 2007. It's 30% of the revenues of Apple Computer. Something that was created 3 years ago is powering up Apple Computer to be the second largest market capitalized company in the world. But in 2003, they were nowhere. Okay, but through the process of thinking different, through the process of thinking about things in an innovative way, or from a certain style, they made it the most successful or the largest capitalized company in the world. And look out, they got the iPad now, and they've got a couple other products that are coming. So I'm submitting to you what looks like a not-so-great industry, the fund-to-fund space, is going to change dynamically over the next 10 years, and I certainly hope that SkyBridge will be a part of that. And if you're a hedge fund manager out here, and we're talking about how you market yourself as a hedge fund manager, you have to think differently. Don't go to hedgefund101.net and print out your PowerPoint presentation. Okay? There's something about your individual personality. There's something about your DNA that you certainly believe in, which is why you're starting your business. Define it yourself. Be authentic and be original. Do you think I really care that Joe Nocera is taking shots at me on the front page of the business section of the New York Times? Could care less. Okay? I just want to represent who I am, and I want to be comfortable in my own skin. And that's what you need to do in your own business. And if you do that, okay, and you be the person that you're designed to be, you're going to attract assets to yourself. Okay, so that's the end of my formal remarks. And I would really like to take questions. I think I have some time, right? So we've got like 15 minutes. Got to take some questions. Thank you.
Richard at RBW Capital. Anthony, are you allocating to managers that are buying the U.S. dollar to yen, also buying Japan equities and hedging the bond markets that will eventually rise by 6%?
I'm assuming everybody can hear the question in the back from the right. I don't have to repeat the question. Currently, we're not. That's not to say that we won't in the future. We're style agnostic as an organization, but currently we're not participating in that trade. What has worked for SkyBridge, we have a registered investment company product, which is like it's a 40 Act product. It's sort of like a mutual fund. It's a fund of funds with a mutual fund wrapper. Literally has a $50,000 minimum. It's got an NAV daily, and it's got a 90-day lockup. In that fund product, we're up about 9% versus 1 for the HFRI. Why are we doing well? We're in the residential mortgage-backed security market deep, and we're in the distressed markets right now quite deep. Equity long-short hasn't worked. We've always been puzzled by Japan. Any time that you have gigantic government intervention, it creates all of these weird anomalies in the markets that make it very difficult for us to understand. So we've avoided it for now. It does look cheap, though. If your point is that it's really cheap and it's attractive, that's probably a point well taken. All right, come on, guys, help me out. Make up a question. Give me one. I'm going to give you 5, 10 more minutes here. Give me another. No, come. Thank you.
Question. In the seeding business, anecdotally, most fund flows these days are going to much more established managers. So I'm wondering at SkyBridge what you're doing to continue to grow that business, and you're finding managers and you're finding investors who want to participate in the seeding business. You described it.
Yeah, the seeding. Look, I've been quoted. Some of my partners think I'm nuts, which I sort of am a little nuts. I've been quoted as saying that the seeding business is a nuclear winter. I don't know if you saw that in pension and investments, but I think the seeding business has been a terrible business over the last 3 years. And the reason why it's been a terrible business is that anything that looked normal from a risk perspective got blown to pieces in the 2008 crisis. So now you can sit here and say, okay, geez, seeding in the worst possible environment in 81 years, seeding has not worked. So let's kill seeding and we'll never talk about it again. Or you can look at it clinically, you can take a step back and think about it the way a Steve Jobs would and say, what is it about seeding that does work, and would it work in a more normalized environment? Okay, and I think, and I submit this to you, I believe that seeding does work. I think it will work in a more normalized environment, and I do think, as I tried to make in my formal remarks, that there are emerging managers, there are really super smart guys that we can attach ourselves to and we can help them grow that could become the next John Paulson or the next Danny Ock. That's not a pie-in-the-sky thing. Seeding, where I think people are making a mistake in seeding, is they treat it like a fund of funds plus an equity kicker. Okay, and I think that's a very big mistake. Where you have to come at seeding is that it's one part venture capital, it's one part intellectual capital analysis. You have to analyze the talent. And it's one part being a private equity investor where you have to stay in there with the guy. So you have to be anti-momentum, and you have to be thinking about it as a business builder. Okay, now with all of that, and I've tried to do all of that, business still blows. Okay, but here is where I think we're going to go with seeding, and I think this is where the next generation is going to be. I hope SkyBridge will lead it, but if we're not leading it, I hope we're a part of it. I think that the next generation is going to be to create a platform for the seeded manager where you get the NAV, that's one part of the layer cake. You get the special equity return, the revenue share, that's the second part of the layer cake. And then the third part is the transactions that are created from the manager. Okay, SkyBridge right now is working on a mechanism to repatriate a portion of those fees back to the underlying investor. So if I could set this up where we put the guy in business, you get the NAV, you get a piece of his business, our sales and marketing team is going to go out and raise him or her capital, but then as a piece of his transactions, his or her transactions, we flow that back to the investor as well. I think that's going to be very differentiating. I think that will be exciting to people. But the business has not been a great business in the last 3 years. But I'll tell you this, Dan Stern, who I have an enormous amount of respect for, Reservoir Capital, he's in the market raising a several billion-dollar fund for seeding. Tom Hill, I have an enormous amount of respect for at Blackstone. He's raising a $250 million seeding fund, I believe, through UBS. And so there are very, in my opinion, smart people that still believe in that business.
This is more a comment than a question, but to be honest, I think you should be addressing your remarks to investors rather than hedge funds about differentiation, because in my experience, if you don't fit into a particular bucket, potential investors just say, oh, we don't know where to put you. Sorry, move on to the next guy when we can, because we know we're looking for X percent of this and X percent of that, and if you're somewhat outlandish or do something different, goodbye.
Well, I think that the topic I think they asked me to talk about was how does a hedge fund manager differentiate himself. But as it relates specifically to investors, you know, I have a so maybe this could be overly philosophical, but what I really believe about individual investors, or you pick the genre of investor, pension fund investor, family office, etc. I really believe that the mistake is made by trying to be like everybody else. So what I would submit to an individual investor or to an investor in large, turn down all of the white noise. Turn down all of the traffic and all of whatever you think other people are doing, and focus on what your individual goals are. What is your actuarial target? What are you trying to do for your family? What are you trying to do for the pension fund? Dial everybody off and build the plan from the inside to the outside, as opposed to what most people do is they build the plan from the outside to the inside. Okay, the people that made mistakes on the Bernard Madoff situation are a clear example of that. I have a really smart friend. He's invested in the Bernard Madoff situation. This guy's like a T-ball. He performs 1% a month. By the way, you can't get in there. Oh, geez, I want to get in there. How do I get in there? You see what I'm saying? No due diligence done. Okay. I would submit to an investor, and I said this at the Harvard Law School last week. This is actually quite funny. I got invited by the dean to talk about my book at the Harvard Law School. There were only 30 kids signed up. I got into a bruising battle with the President of the United States on CNBC. We had 400 kids sign up. That just tells you how stuff works. But what I said at the Harvard Law School is that investing is not like an American court. The person you're giving the money to is guilty until we prove them innocent. Okay, so as an investor, what I would submit to any type of investor, whoever you're giving the money to, never give the benefit of the doubt. I don't care if it's SkyBridge, I don't care if it's low bridge or no bridge, it really doesn't matter. Don't give the benefit of the doubt. Don't invest because your friend's investing. Don't invest because you think the guy's really smart, he's got a good pedigree, you saw him on CNBC, or you read about him in the Financial Times. Do the homework and build it from the inside out. Is that a reasonable comment?
I think you're agreeing.
Yeah, I am.